Welcome to the Cashflow Academy podcast, where we make investing a lot of fun, simple, real. Boy, it's going to be real today. We're going to pick stock and talk about how do you get a double-digit return as a baseline? How do you start with a high confidence, never any guarantees, but say, hey, how do I get something that's going to give me some double digits to start with? So we're going to give out a stock today. I don't know where it'll be by the time this airs. Who cares? Buffett's been buying it forever. So it's going to be a fun one. I'm joined by Noah Davidson and Corey Halliday, my good friends, and also chief instructors at the Cashflow Academy. So, gentlemen, welcome.
Excited to be here.
Awesome. We'll do introductions. Be sure you like, subscribe, notification bell, all that drill. Also, if you have not done so, for sure, go now to cashflowbonus.com. Get free stuff. And it's stuff you can take action with. And if you like today's episode, it's just a rocket booster for what we're going to do. And it'll really fit in with the stock we're going to talk about today. I thought, I hate the culture of advice. People always ask me for a stock pick all the time. And so a couple days ago, I was working with a company that asked me to be a guest teacher. I like their stuff. They teach a lot of different things. They teach very basic introductory classes. They don't do advanced stuff like we do. But they said, Andy, could you build us a real simple course, just for beginners? I said, sure, I'll build it for you. And we did a deal, and off we go. So then they wanted to promote it, and they call me up and they say, hey, we want to promote what this is, and they're marketers, and so I bang my head against the wall because they know everyone wants advice. And they go, could you just do a demo for us? And it was really funny because they said, what's a good goal? I said, well, somewhere between infinite return and losing everything you have. That's a good range for expectations. They go, no, really? I says, well, for someone like my sons that have a basic education, we start with double digits and then we grow it from there, and we try to get to an infinite return with no risk eventually. Like, this morning we were talking about your, risk-free trade. And so what was funny is this was yesterday, and they said, you say you can do this in a couple of clicks. How fast is it really? I said, that's a couple of clicks. And so I have this little thing on my computer where it will show what my phone screen is. Have you seen that on Apple? It's kind of cool, a little phone thing. And so I bring up my account, and I go boink, boink, bang. And the whole thing was 10 seconds.
Yeah.
And they're like, you got to be kidding me. And I said, I think this, and they go, what type of return are you going to get on this? I go, my guess is double digits, probably 10, 12, very confident 10, 12. Eventually 20, and then I'll put it in the 20 pile. And I don't know what the rule of 72 is on 20% a year. It's probably like 3.5.
About 3.6 years to double your money.
About 3.5.
Hey, man, how you doing over there?
Yeah, so
well, it's exactly half of 7.2 years, so it wasn't too
12,
hard.
It's 12 minutes to Wapner minus pi.
I'm an excellent driver.
Yeah.
I'm an excellent driver.
I got to tell you, but
Get me at a blackjack table, though, boys. And
my dad lets me drive in the parking or in the driveway. I'm a very good driver. So you are a very good driver.
Yeah.
But and it was kind of weird because we do all of us. It doesn't. It's like there it is, and these guys are like, what? How did that? And because some people, I've got a friend who does hard money lending, and he'll loan a developer some money, and gets 8% usually is kind of the going rate for hard money lending, and it's backed by real estate. And they're like, how in the heck do you just think? Because if you look at a portfolio at 8%, and then you look at a portfolio at like 12, and you can't really extrapolate this. People want to, but you have stuff that does less than that. Let's make sure you have some stinkers
and some stuff that does more.
Yeah, for sure. Yeah. But what was interesting about this one is, I'm always talking about one of my favorites because it just worked out well for me was Exxon, and why I think it has a moat, and when I bought it low, and all this type of stuff. And so today I'm going to talk about a different one that I have not purchased until now. We've talked about it a lot. You've bought a bunch. I think you probably still own a bunch.
I still own some, and you're going to get it at a better price than where
Warren Buffett got it.
Yeah, where Warren Buffett got it, and my price is a little bit higher as well than where it's at, but my actual price is probably lower now because I've cash flowed so much.
So this is not to give a stock pick. We don't give stock picks. It's to educate. Should put a disclaimer on this one. Education personal only. And you can lose all your money in the stock, which is why I don't in podcasts generally do stock picks. But the reason this is cool is, part of the reason we do the podcast is for people. It's a great way to promote the Cash Flow Academy and what people can get. And if I were to say, reveal a motive transparently of, why I'm going to share this is because Noah's going to do this one in the Mentor Club. So here's a chance for listeners to join the Mentor Club, see this trade front to back. It'll be a staple. It'll be an addition to the portfolio. I don't think it's going to find its way out. It might. But I'm going to talk a little bit about a trade that smacks, it's not quite an ExxonMobil, but Warren Buffett owns Chevron, and he owns this one we're going to talk about. He doesn't own Exxon. But let me review the Exxon and why let's tell that story where everyone can say, well, that'd be great if I'd have done it back then when you did it, Andy. I'll say, all right, well, I'm doing it again.
Yeah.
Okay, I'm doing it again. And so I don't know how, I told the producer this is a half-hour podcast. Probably will never be that with us, but we'll do our best. So the first thing that I love is let's talk about the things that won't change. So if you listen to the podcast at all, I can promise you this one. What we're going to do right here, front to back, in making this pick, why we make it, how we're going to make the money, the whole bit, unbelievably simple. For anyone who's even a beginner level trader, what we're going to do today is kindergarten stuff. Okay, we're not going to talk about elaborate stuff. Kindergarten stuff. Very easy to do. Very, very simple, low risk, awesome little beginner trade we're going to do today. So this is the first real nugget you can get. And if you've listened to the show at all, you might catch this. So Jeff Bezos, I knew this before he said it, but the way he said it was so articulate that I'm going to just quote him like it's an original idea from him. It's not, but it's really well said. He's on a panel, some type of panel, and some dude says, hey, Jeff, what do you see the big changes are in the future coming up? Is it AI? What's the big changes? And Jeff was a master on this one, and he said, well, that's a great question. Always interested to speculate on what may change. But he said, if you want to make a lot of money and take away a lot of risk, figure out the stuff that will never change because you can count on it, and it's predictable, and you can build a business on it. I was like, man, that is really well said. And we knew this, and Buffett knows this. It's called a moat, is what it's called. Yeah. And so when you think about that, what will not change? And that's how I think about a lot. The story I tell about this investing lesson is Costco. Let's say there's a recession. What does Costco look like? Hundreds of people showing up on Saturday with money in their pocket, going to hand it over for maybe less than they normally buy. But the thing that doesn't change is the cash flow pattern that goes from consumer to producer.
Yeah.
So the one thing you can bank on is that whether it's recession or whether it's high growth GDP, what do we call it? Growth. I guess you call it a growth economy or recession economy. The cash flow goes one way. Own Costco, and you only make a lot of money or some money. Yeah. But you're not gonna, the money's not gonna go the other way. So the other part of it is people say, well, I want real estate. Well, great, go buy real estate. Fantastic. Well, it's because I want to see, touch, and feel it. I don't want a piece of paper. Okay, I'm tired of that bullshit. I'm so tired of that. Absolutely tired of that. It makes me crazy. The next person that tells me that they want to invest in something they can see, touch, and real, and that stocks are not real, come on over. And I'm going to take you to the train track. We're going to talk about a stock called Berkshire Hathaway, which owns a railroad called Burlington Northern Santa Fe. Yeah. And I'm going to put you on the railroad track facing it, and just in a moment, you'll hear it first. Yeah. Before see, touch, and feel, you'll hear it first. and you will see it, okay, and you will touch it, and you won't feel it very long, but you feel it for a second.
Yeah.
And I'll just see how much you believe that's imaginary. Because in order to build that house, where does the lumber come from? The real lumber that you can see, touch, and feel. Well, it comes on the back
on the train
of they did what, 12,000 tons of lumber or whatever it was.
Yeah.
Something's grain. So it's real, for hell's sakes.
Yeah.
If you don't believe Apple is a real opportunity, then take your phone and throw it in the ocean, or don't pay the bill and AT&T won't, it's real.
Yep.
And so I'm tired of that. One of those things, you got food, clothing, communicate is food, clothing, shelter. Oh, so communications, you don't need a phone. We don't need to communicate. That's not a need now. That's a luxury to have a phone. Oh, medicine. That's not food, clothing. Medicine's a luxury, is it? We borrow money to give people health care now.
And energy. You're
and
going
there
to
you
live
land.
your life without air
There you
conditioning
land.
and heating
and driving
traveling
and yeah. So Al Gore comes out and says, hey, we can't do any more fossil fuels. And we were at 85% of the world's energy is fossil fuels. And since that documentary and Continued Truth, we've made tremendous progress. We have gone
now
from
it's
85, it is 84. So we have we're crushing it, Al. Great job, Al.
Big move away from oil.
So what a moat is. So the first lesson, okay, we'll outline the lessons. Lesson number 1 on this podcast of how to start a base of double-digit return, how to set a goal for double-digit as a base and then grow it from there, is that, number 1, find out what doesn't change and bet on it, okay? Energy ain't going to frickin' change. We're going to need it. That's a moat. Lesson number 2 on the moat. Burlington Northern Santa Fe. Rail is 40% of the nation's freight in North America. It takes $500 billion to build a competitor to Burlington Northern Santa Fe. That's what a moat is, okay? So ExxonMobil, third lesson, cash flow. ExxonMobil is they're like this ambassador. They're working towards dividend ambassador status. I think we're closing in on that 40-year mark where they've raised the dividend every year. What the hell more do you want than that?
Yeah.
I mean, I'm in junior high when they start raising this dividend, right? And they're raising all the time, okay? So next principle, I'm just firing them off, right? We got things that don't change. We got something that's a moat. We got something that's real. We got something that's going to cash flow and has a track record of 40 years in a row of increasing how much they pay the shareholders. That's crazy. Okay, next, sale. You see a dip and you say, okay, so mine was COVID, and there was a catalyst. There was a catalyst that hits and it drops the price down into the 40s.
Yeah.
So I pick it up. So now you've got so I buy this, and the dividend wasn't then what it is today when I bought it, but today the dividend kept on growing. The David dividends, it's going to turn over. It's 99 cents a quarter. It's $4.96 a year. It's going to be, $3.96 a year. It's going to be $4 because they move it, and the minimum up they can go is to $4 a year. So if you bought it at 40, and you're getting $4 a year, well, there's a double digit out of the damn dividend.
10% return just from the dividend.
Okay, then we're going to add our options and all that stuff, and you get to 20. So you start out with double digit, and then you go to 20, and then you get your 3.5 year Rule 72, free and cleared, compound, off we go. A lot of principles here: compounding, cash flow, liquidity, click and get paid, real stocks, not imaginary. I can't tell you, I don't have syndication. I have one investment in real estate that's going to crush that over time. It's it's making money while you sleep. So there you go. Okay. So go back to yesterday. I know I'm talking the whole podcast, but my story, I guess, I don't know. So yesterday, these guys go, "What are you looking at right now? Can you do one for us?" I go, "Yeah, I'll pick up some more shares. I've already got some set up, but I go, yeah, I'll buy some more of this." So I click and I sell a put option that makes a promise to buy Occidental Petroleum at the money, like at $43 for 25 days.
Yeah.
Is how much, as of this podcast, 25 days as of yesterday. So I make I want to say it was like 3.8, just under 4%. So I'm going to have a head start that's bigger than their dividend by simply promising to buy it. I'm going to get paid.
Yeah, right now Oxy pays a 2% dividend annually. You're picking up 4%. So think about the difference. I got to own Oxy stock for a year to get my 2%. In 1 month, just selling a put, which is making a promise to possibly buy the stock in the future.
If it stays low.
You're picking up 4%. If we annualize that, 4% times 12, that would be 48%.
See, I'm the Rain Man, 48%.
Yeah.
That'd be 40%.
So you're getting 4% right out of the gate.
This is not my underwear.
Man, now you guys are making me feel bad because since we started this conversation, I sold 2 puts on that and collected 2% on capital used. And I'm feeling bad about my 2% now because I went out of the money.
Yeah. See, I went at the money.
Yeah, he went at the money. You went out of the money.
So I get a
you
little
could
more.
end up with a better cost basis possibly,
yeah,
but he's going to get the bigger premium.
And I want the
front.
stock anyway, and I want to increase my chances of having the stock put to me.
Yep.
You have a lower chance of buying it. I have a higher chance of buying it because I want it, but you will get it cheaper if you get it. So we'll have a contest.
And this discussion shows how options give you options. 2 different traders, 2 different strike prices chosen, both income generating, click and get paid. This is stuff that, yeah, exactly. But this is stuff that is awesome for the listener in that these are real actionable items that is simple to do. I mean,
but it's 2 clicks.
It's the
click, done.
It's simple. Under 10 seconds, you get it done.
What's the band Saliva? Click, click, boom.
Yeah.
Ba-na-na-na-na-na. Ba-na-na-na. Okay. So let's talk about the moat of the company. So the first pillar of investing that you learn at the Cash Flow Academy is fundamental analysis, which is how to value a company and look at it. And it's cash flow jack in the box, really. What is the work that it does, and are they doing it efficiently, and is it a good company? So the thing that put this on my radar, I'll let Corey tell the story, is Buffett loaned him some cash, and they had the option to pay him back in cash or stock, and tell us what happened.
Yeah,
this is a couple years ago?
This is a few years ago now, probably. I don't know.
5 or 6.
COVID.
Okay, so
actually, it was before
5 or 6.
It might have even been just before COVID because it was during COVID that this whole thing transpired. So Occidental Petroleum was buying out a company called Anadarko, and they needed capital. And so they went to Berkshire Hathaway. They worked out a deal where Berkshire lend them the money, billions of dollars. Oxy has to pay them interest for that, like a normal loan. But in that, Berkshire can decide. So Oxy can say, hey, we'll pay you in stock or in cash. Berkshire can either accept that or demand the cash. That's Berkshire's option, right? During COVID, all of these energy stocks fell. That was to your point in your story of where you picked up Exxon is COVID. Now remember, back in COVID 2020, oil went negative. People hadn't even considered that oil prices could go negative in price.
Got to pay you to take it off the
futures
hands.
Went literally
Noah has a
negative.
bathtub available.
Yeah.
Give me a couple of barrels. I'll take it off your hands. You got to pay me to do it.
The reason that happened is oil will spoil, right? And so
oil will spoil.
And
I'm
so
a poet and didn't know it.
You can't just sit there, and people didn't want to accept delivery and so on. So they would actually pay someone else to be forced to take that delivery and so on. You saw video back in those days of the milk companies just pouring milk out on the ground because it couldn't be delivered or what have you. So this whole crisis created huge opportunity where these oil stocks fell. Well, Oxy, like everyone else, fell significantly. And they went to Buffett and they said, hey, we'd like to pay you in stock rather than cash because we want to make sure we have enough cash. And Berkshire, interestingly enough, said, no, I want the cash. He could have been collecting the stock at a much lower price. Yes. But this speaks to Warren Buffett's risk management / willingness to not worry about how people perceive him or whether he made a mistake. He just makes what he feels like is the best decision given the facts of that time. And he said, look, it's too risky for us. We've already lent you a lot of money. We need to have some of this money paid back. Occidental, we went through the crisis. They recover like everyone else. Buffett could have been accepting stock at a lower price. He didn't do that during the crisis, but he actually was listening in on the conference calls of the earnings, and he said, you know what they're doing, the way they're operating, their fundamentals, I actually believe in this company and their prospects for huge growth. So instead of getting stock delivered to him at like $15 a share during COVID, he actually started buying. So he started spending Berkshire's own money at like $45 a share. Right around there is their kind of where they started to initially buy. They bought some in the 50s and so on. Now the stock's down to 43. So he actually paid more. And someone might say
his first one was 7.47 million shares in Q3 of 2019.
There you go.
At 47.28.
There you go. So he started buying at 47. And you know, I love this about Buffett because Buffett doesn't say, well, I should have accepted the stock, and since it's higher, I won't. He just said, look, if I think it's a good value, I'll pay it today.
March 9th, 2022, bought 25 million shares, 25.9, $57.
Yeah.
May 14th, 2022, 17.6 million shares, $55.
So he's buying at 57, 55.
5 million shares, May 2nd, 2022 at $58.
Yeah.
$59. There's 38 purchases. 55, 56, 59, 61, 59, 61, 57, 57, 57, 54, 61, 59, 58, 42, or 62. Sorry about my glasses. 62. So his average, I haven't done the math on this, but his cost base is probably in the high 50s.
Yeah, and you can pick it up today at a significant discount to Buffett's price. And Buffett's still happy with it. How do we know that he seems happy? Well, he's not selling.
He's bought 38 times in a row.
And number two, he actually had to get approval because there's limitations on how much of a percentage of a company you can purchase without basically getting into hostile takeover mode. So you have to
moving them,
so you have to agree, basically send a notice to the company and get approval from them to go over the 20% ownership.
I was just wondering how you would feel about a hostile takeover.
Yeah. but that's the risk.
Yes, I'd like to speak to the hostile takeover department. You got to speak to a manager, please.
But actually,
I need a supervisor right now.
They wanted to go over. They wanted to go over that 20%.
What button do you
Supervisor.
push? What button do you push?
No.
Agent.
I want to talk to a real person. Supervisor.
Hola, ¿cómo te llamas? But he spoke to the CEO and he said, we want to own so much of it. We want to go over the 20% threshold. But this is not a hostile takeover. You know, we just want your blessing.
It's a friendly takeover.
It's a friendly one. It's a handshake takeover. You know, so
he's such a
polite.
nice guy.
Yeah.
Polite.
Yeah. And so he got approval from the SEC to go over that 20%, and they've continued to buy more.
The first pillar of investing is fundamental analysis.
Yeah.
When Buffett buys a stock, you can almost check that box right there because he's going to do a better fundamental analysis probably than anybody ever has. So he's been building this position for 5 years. Well, I saw ExxonMobil drop to the 40s because of a catalyst called COVID. Well, we have this conflict with Iran and oil, you know, they worry about it and all this. I don't know, but I do know it's down lower than it's been. It was high as 70. Will it go higher than 70? I have no idea. I know that ExxonMobil was around 70 and then it fell. Yeah. I got my eye on it, sold my first puts at 55, bought some puts for a cost basis at 44. So I'm in ExxonMobil in the 40s. So I look at this one and I say, they pay a 2% dividend, not as good as Exxon's. But if I can get 3 plus and 2 plus, you know, that's a net of about 6.
Yeah.
It's a net of about 6%. Half of that's up front, and the other half I have to believe that a dividend will come.
Yeah.
Okay.
And they did just raise their dividend, which is more of a key factor.
Yeah.
When you look at dividends, a lot of newer investors make the mistake of looking for high dividend yields.
Well, it's like a junk bond.
It's like a junk bond. The higher your yield, the more dangerous the market's telling you it can be, right? If you were looking in the bond market, if you go and buy
Brazil is a energy company that's had double-digit dividends and lots of corruption with the government.
Right. And so there's a higher level of risk. It's one of those things where if you look at the bond market, they like to call it high yield bonds, not junk bonds, right? Yeah. But if you're going to invest
junk
in
dividends.
One of those, this is a junk dividend if it pays too high. Well, Oxy's not one of those. It pays 2%, but importantly, they're raising the dividend. And that's the key factor is they're making money enough to increase their dividend payout to investors. And so it's not about the total percentage. You know, when I look for dividends, I'm not usually saying I want something that pays me 12%, 15%, because that would tell me that's a crazy wild stock that's probably tanking. But I want a company that's raising their dividends, that's making profits.
There's a margin of safety here. See all these little lessons coming up: margin of safety, moats, technical analysis, fundamental analysis.
Crazy hot scale.
Yeah,
we got a link to know. Check out our on this YouTube channel. You got to check out Noah's crazy hot video.
The crazy hot video at the Cashflow Academy YouTube. Check that out. That's a good one.
We were like, okay, we really are flirting with getting canceled at this point. And we went to the powers that be behind the scenes. We go, what do you think? Crazy hot video on stocks. And he's like, yeah, what's the worst that could happen?
By the way, we might already be canceled by the time.
All I can say is the music is chicka bow wow, chicka bow wow, chicka bow wow. The payout ratio on Occidental is 34.
Yeah.
So that means that, what is that, 66% of their money
that they retain. They
can either R&D, buy back. And Buffett, when he talks about dividends, he loves companies that pay dividends when they say, look, this is the amount of capital we can reinvest for growth. This is the amount of capital that we really don't think we put a good use to. So give it to the shareholders because Buffett can invest it better than they can. Yeah. And he said that before. So now you're at 6%. You got 2 and change, 3 and change. Sell your put upfront, guaranteed cash. If you get it put to you, if you don't get it put to you, do it again, and you're on pace for what do we say, 30 to 40% a year.
If you get another 4%. Now you're
8, and you just
you're
rinse
working
and repeat.
Towards that 48%.
Just trying to pick that thing up. Yeah. So great. Now, if I get it, which I hope I do, I was more aggressive than Noah was, but if I get it, I can ride a 10 delta. Conservative out of the money call, and I might have to deal with getting called out, which is risk management, trade adjustment, buy shares to hedge, roll up, roll out, buy back, whatever. But I think conservatively for Occidental Petroleum, 0.5% a month is not. Do you think that's psycho to look for on an energy stock?
No, that's 6% annualized.
Okay, so that's 12.
Yep.
Pull back, maybe you do a little better than that some months. That's without the stock moving.
Yeah.
That's beating market averages over the last 100 years.
Without the stock moving. And when I say price doesn't matter, I could give a rat's. Well, look. Here's the deal. When you buy a pair of jeans and you take them home, what do you do with the price tag? You clip it off and you wear the jeans. When you buy a stock and pay the price, I paid $42, I get off, I clip it, and now it's time to see the golden eggs come.
Yeah.
So here's what's interesting is how does this, so you start with a goal, not a guarantee. A goal and both start with G, but they're different. So you start with a goal of double digits, start with 12. Okay, great. Now let's say it gets to 70. Well, if it's getting to 70, that's because the value is increasing and people are seeing it. Chances of dividend trying to keep up are very good. But even more importantly, now if your cost basis is 43, and you whatever it is, and now you're writing calls at 10 deltas with an at the money strike. You're writing out of the money calls where the at the money strike's in the 70s.
Yeah.
Now you're getting 1% a month on this right here, plus your dividend. Now you're getting 14, 15.
That's part of the benefit you've seen in Exxon is as the stock has gone higher, the amount of premiums you're bringing in are even bigger. And so that's a
my
big
level
benefit.
of aggression doesn't change with standard deviations. I still get a nice low delta with fat premiums.
And that's the beauty of buying on the
On
deeper
dip,
discount,
on the catalyst
bigger
discount.
Yeah.
So thank you for whatever's going on in the Middle East. We don't like seeing people hurt when it causes something to go on and sell you buy. It's not a COVID dip, but if I can buy Oxy, if Buffett's buying it at 50 and I can buy it $10 cheaper than him, I just got a better deal.
Yeah.
And it's funny because some people say, well, he's an insider. I hear this all the time. Well, Buffett's an insider. He buying that. Look at the prices he bought it at.
Yeah.
You got to have a 13F that you file that shows where you're buying this stuff, and it's all transparent.
And he's buying in the open market like we are.
The other thing, now, we talked about fundamentals, cash flow. Risk management starts with the moat, the quality of the stock and the work that they do.
Yeah.
But I certainly have some risk management because now the stock can fall, at least 6%, and I'm likely to still have exit if I could, and that really helps. Falls 10%, I'm only losing 4%. But talk about the technical analysis of this, Noah, because if you see Warren Buffett and you see where he's buying at, and you see he's not going to do a hostile takeover, but can a guy of Buffett's size bring in some support?
They can create support. Again, there's a fundamental valuation. You look at it on a deeper level. There's that book value. On the crazy hot scale, it's a solid 7, maybe an 8, with a rich grandpa.
You know what?
A trust fund.
Couple of beers and and this stock could be
the beer goggles on, and that's a 9.
But what you get is the stability of the personality. It is not a high beta type of stock that's all over the place crazy. It's awesome for somebody who's new to the idea of investing because it's not, again, a volatile, high-risk scenario. It is, pays a steady dividend. It's got steady option premiums. It's got well-defined price levels of support resistance. It's kind of a no-brainer in that regard. Again, that guaranteed, not a guarantee, void where prohibited.
Gold, not guarantee.
Yeah, but when you're starting with a quality asset, you have no fear of investing in that asset.
There you go. There's your risk management.
So you're saying
right
on the hot. So she's not a super hot stock. She's more on the stable side. She's one that you might marry.
Or he, if it's
whatever floats your boat, really.
No, if it's a he, I mean, if you're we have a lot of female investors that will say, this is not a Brad Pitt stock, but it's a solid
6'5", works in finance.
It's like a Hugh Jackman. I don't know.
Well, I'd say
you guys are describing
better than Luke
10.
Skywalker.
I'm pretty sure Hugh Jackman's still up there.
He's
Well, his
9.
body is pretty good.
9 and
I'll
a
tell you
half.
that. That Wolverine roided out body is awesome. I talk about beer goggles. Here I am growing up in Utah as a moment, boy, I don't know anything about beer, but I do know what's worse than beer goggles. What is worse than beer goggles on a man in a bar? Parent goggles at an AAU team basketball game. Look at my son. Look how good my son is. Isn't he amazing? I'm like, your kid sucks. You got parent goggles, pal. Let me tell you what. Frightening. So look, is Oxy going to be another Exxon for me? Yeah, probably. Maybe not. Position size, I'll add to it. But I guess it isn't like, go buy Oxy. And he said buy Oxy. See, I didn't make a price target on this. I said maybe it gets up to 70 again. Hell, maybe it gets to 140 in 10 years. I don't care because have I sold my Exxon now that it's doubled and at one point almost tripled? No. Yeah. Why? Why would I sell something that's cash flowing 20% on investor
based
rate
on
of return?
your cost basis?
Yeah. Why would you sell that in a million years? Why sell a golden goose because someone thought it got fat all of a sudden? You're gonna lose generations of cash flow. You're going to lose so much money selling Exxon at that price because my children's children will get a piece of that out of the family trust as you build legacy and think dynastically. So there's a stock pick, big deal. But is the value that I say go buy Oxy? Because most people don't know how to do any of that stuff we talked about, and it's kindergarten level stuff. But most people just want to, what's the price going to go to, Andy? I don't know. I don't care. Yeah. And that's really a big lesson of the difference. So here's a sales pitch for us. And we didn't even do a break, did we, Mars? We just totally ignored our producer here. He's shrugging her shoulders. She's like, you guys are in the 9th grade talking about
That's
beer
all right.
goggles.
Go to cashflowbonus.com. And
there's a commercial. Get your free stuff.
Get your free stuff. Cashflowbonus.com.
Or do something better than that and get serious.
Yeah.
And Noah, so one of the services we offer at the Cashflow Academy is called the Mentor Club, and Noah gets in there and he does real trades like this, so people can watch and follow along in their paper trade account to learn. If someone does it for real and it doesn't work out, don't cry to me. I said practice on paper. But you're going to do this trade, yes, on Monday, and whether that's before or after we release this, I have no idea, but it doesn't matter.
It'll be
because
in there.
Oxy's not going to go to 70 tomorrow. This trade is going to be around for a bit, but every month you're not doing it, you are losing that cash flow, and that's a big lesson.
And what you'll get to see is how we generate cash flow next month,
Yeah.
and how we generate cash flow the month
and
after
what
that.
if it goes down to 30?
And how
and
we roll the
what
options if we need to.
And what if it skyrockets past my strike?
Yes.
And all the stuff that we have to deal with is you get to manage that. And we did a podcast about having mentors and the advantage of doesn't matter what you know when you hang out with him or him. Doesn't matter what I know when I hang out with him or him. Why do you think I have you guys around? Because I know, I couldn't trade my way out of a wet paper bag, right? That's why I have you guys. No, I mean, the reason I decided to talk about Oxy and this whole process of finding a nice little double digit that we think we could turn into from a 10% to a 20% in not too long is just because these guys were like, geez, click, bang, boom. And the thing that is the the money, it's 3%, it's not you're not buying a yacht, but the likelihood of success in this is really, 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 really good in a trade like this. No matter what the stock does right now, if it goes up, I'm compounding it per annum at 30 to 40. If it goes sideways, I'm picking up the stock, got paid to do it. If it goes down, it could have gone down anyway if I'd have bought it at today's price. So I'm not taking any more risk than if I bought it today. I'm actually taking less risk because I'm taking 3% less risk exposure by doing this today. That's why it's more conservative than buying stock. You could do this in an IRA, for hell's sakes.
And all that income you're bringing in over time. So you sold a put and you got 4% immediately.
Yeah.
That 4% could be reinvested into a new stock. So say that at the same time that you're buying Oxy with some cash you have, you could be reinvesting capital that's coming in, that cash flow, into another stock. Let's say Oxy just baselines and just keeps pouring in cash flow month after month. That money can be filtered into another stock that might boom.
It's Dow Chemical went sideways. Kraft Heinz has gone sideways. We've got so many freaking sideways
stocks. But the money coming in can be reinvested and just create its own benefit. So, and then that compounds and that cash flows.
What's crazy is when I click and get paid on that, and you click and get paid. Like I say, click, give me the money now for the promise. I can take that money and go buy stock.
Yep.
That was enough cash flow generated right now to go fill up my truck with gas and the boat that gets out on the lake.
Yeah. What's funny, and that's like a couple of contracts probably just for fun.
Yeah, just for fun.
But what's funny about this is when I started teaching my son in the COVID year, Zach, when he just finished the 8th grade, I'm like, we're not going to burn a basketball year sitting there with COVID and a mask on. We're not burning a year of high school eligibility. Forget that. Freshman year, we're preserving. So I says, let's come home and learn this. And that's the lesson. We went down to the Exxon Mobil gas station, and we filled it up, as a exercise. And he saw, it was like, $80 or I don't remember how much it was, whatever it is to fill an SUV. And then we went home, and he said, wow, that's a lot of money to fill the car, Dad. And I says, yeah. Now we went to the credit card statement of Amex, and he saw what we spend a year on gas consumption. And then we went to Exxon, and already I said, now look what's happening and happened.
Yeah.
Is because this was probably March, COVID, all the way to September. I says, look at this, and it wasn't even freaking close, and he got it, like right there. He's like, okay, we make more money by production, being on the other side of the cash flow, the cash register at Costco. We make more money by the energy we produce than we spend on the energy we consume, and then we did it with the phone and AT&T, and we went through all these different products, and we just looked at how many times that adds up being a net producer. So hopefully this podcast was entertaining and fun. But also, you can see the power packed. I mean, there's a lot of concepts we touched on. So, great job listening and tuning in, listening to our attempts at humor, failed attempts at humor. But it's supposed to be fun. And hopefully, you can see this is pretty simple. And this opportunity, they're everywhere, even real. We don't have to have a huge market crash to say, oh, I can pick this up cheaper than Buffett.
That's right.
That gets my attention. I did that with a bunch of Buffett stocks. Back when he used to have Hewlett Packard, I got it lower. Delta, I got it lower. A bunch of them. And that's a nice little strategy to see what he owns. And then your fundamentals are really done better for you than you probably could have done them yourself. And yeah, it's just it's the simplicity of it that I wanted to talk about today.
Awesome.
Okay, final words, and we'll wrap this baby up.
It's
time to go eat.
Click, click, boom.
Yeah.
You like that? That's really a bad thing, but it's in my son's playlist.
That's
click,
really what
click,
it is.
Boom.
Yeah.
Go to stockcastbonus.com. Also on cashflowbonus.com. Thank you. Editor, help me. Go to cashflowbonus.com, and also on this channel, check out the crazy hot stock matrix.
You got to check out Noah's video. It's a classic.
Yeah. It went viral for 4 people. Yeah. Me, Corey, Noah, and my kids. Yeah. The 4, it did go viral. Just 4 people, but yeah, it's funny.
It might have gone viral by the time he puts this out. It's a good one.
He puts the fun in fundamentals.
He does.
I was
or the
dying.
mental and fundamentals. I'm not sure which way that was going to go.
My favorite line in that video is where you go, he's making a reference. He goes, "No little boy." I can't say it like I got to do it like he does. I got to do it in his personality. Yeah. No little blue pills for you, Grandpa. Not with your heart condition. Okay, enough. All right. Hey, you've been watching and listening to my good friends Corey Halliday, Noah Davidson. We love you guys. We are here to elevate the financial well-being of humanity. For those that want to, we have free resources, very affordable resources. We know a little bit how this stuff works. Join with us, get to know us better. We can't say the things we'd really like to on a podcast because it's an open system. Once you get your unanimous password in the closed system, the chances of us being canceled go way higher. So if you'd like to go back to the 9th grade and hang out in a locker room with a bunch of punks that know how to trade, come join us. But you really do have an opportunity to learn from Noah in the Mentor Club. And if you say, I get this. I want to see how he pushed it and the buttons, and I really want to see how this really plays out, hop in Mentor Club, and we have this stuff every week. So with that, thank my guests, Corey and Noah. You've been watching and listening to the Cashflow Academy podcast. We'll see you next time.